Welcome to Real Estate IQ Wisdom for Smart Moves. We will explore the insider secrets tailored exclusively for Silicon Valley home buyers, sellers, and investors, arming you to conquer the unique real estate landscape. Today, we welcome Ami Shah, the founder of Ami Shah CPA.
Many high earners in Silicon Valley overpay in taxes. Without smart planning, equity like stock options and RSUs can trigger surprise bills. Property owners face rising taxes too. Traditional accounting just isn't enough. Strategic guidance is key. Our host today, Sharad Gupta, is a real estate broker in Silicon Valley and brings a wealth of live and professional experience to his role as a podcast host.
Thank you so much, Amy, for showing up to our podcast today.
Thank you, Sharad, for having me one more time.
Absolutely. And Amy, what are the new tax trends which are emerging in Silicon Valley real estate market?
Silicon Valley is a very unique place compared to the entire US. And I see that no matter how high a person is going to pay in terms of real estate taxes, no matter how much that they might not get the mortgage interest deduction, still people are buying. So I don't see the tax trends affecting the real estate market in Silicon Valley because most of the time the property taxes are not deductible because there's a cap on the SALT deduction. And then the mortgage interest is also limited. But still, so these are like not favorable tax treatments and still people are buying.
And why are more and more tech professionals turning to real estate investing these days?
I believe the fundamental thought behind it is the diversification, right? The stock market being so volatile and plus the tech workers being employed at the tech giants, they have to diversify their risk and their investment. So that is the number one reason. Now, the number two is the real estate investment gives you twofold benefit. Number one, tax deferred income because of the depreciation. And number two, the appreciation or the gain on the sale of the real estate also gets taxed at a preferred tax rate, which is long-term capital gains. So, those are the advantages of investing in the real estate, and the tech professionals are clearly seeing it.
And how some of these high income tax earners, which you talked about, they can use real estate to reduce their taxes?
Real estate is a very good tax deferral vehicle. I would say that because you get the depreciation upfront, so your cash flow that comes in usually offsets the depreciation and you get that cash tax free. Number two is the bonus depreciations have also been helping in terms of real estate. So if you perform a cost segregation study and then reclassify your real estate towards different types of property, then you can take an accelerator depreciation and then offset your rental income.
And what are some tax implications of buying new build homes today?
So new build homes, California mandates solar to be installed on most of the new homes. And so number one, we can take the advantage of the solar and take the solar credits. Number two is, you have to see what the mortgage amount is going to be on the new home because some of the mortgage limits allow you only to deduct up to $750K worth of loans mortgage interest. So that is limited. Plus the TCJA Act also reduced the limit on the property tax deduction. So the $10,000 is the limit on claiming the property tax. And most of the California taxpayers don't get to deduct their property taxes because of the income tax being higher. So those are kind of the things that the new homeowner should think through while buying the new home is that, the mortgage interest is limited, property tax deduction is limited, and they can take the deduction or the credit. They can avail the credit for all the energy efficient aspects to the new home.
Get a guaranteed cash offer on your home from TradeMyHome.com, powered by Your Home Sold Guaranteed Realty. We provide upfront written offers at a price agreeable to you. Experience a guaranteed sell with a hassle-free, highest and best price sell within your time frame. Are you selling your home in the next 3 to 6 months? Text PAIR to 408-740-7400 for a free and no-obligation professional equity appraisal report. For more information, visit trademyhome.com or call 408-740-7400. Remember, at trademyhome.com, your home is sold guaranteed or we'll buy it.
So tell me how this solar strategy or the new solar things which is mandated by California, how is it helping with taxes?
So there is a 30% tax credit for the property which installs the solar.
Okay.
So a taxpayer can take a 30% tax credit. Now there are additional credits beyond 30%. There is an additional 10% tax credit for a property being in an energy zone. And then there is another tax credit for the solar equipment being manufactured in US. So, if let's say you were installing a system for $40,000, you're getting a $20,000 tax credit.
Wow.
And that means that, and it's not a deduction.
It's
the
a credit.
Credits are, dollar to dollar offset.
Sure.
There is no AMT involved into it. So, and if you're not able to utilize this credit, then you can even carry it back for 3 years.
I see.
So the solar is a very tax efficient investment. And we're doing several projects where our clients are investing into the solar project, and then they're almost getting everything back in the year of the investment. And then future return on investment comes number one, tax-free and with no investment at all at stake.
Sure.
So, it's very, very popular nowadays in the tax world.
Absolutely. And as the housing market shifts, right, do you see any changes in the capital tax gain strategies?
Yes, the capital gain strategies really depends on how much you are selling, what's the property gain, what's the depreciation recapture on that property, and then at the same time, whether the replacement property is available around the same price or not, or so. Those are the things that we have to factor in, while we're implementing any capital gains tax strategy. That what's the gain, what's the depreciation recapture, whether the client wants to invest into another replacement property, doing 1031 exchange, or they have some dire need to do it or not. So everything is dependent on, yes, the housing market affects, and at the same time, what the client's goals and objectives are also affect the entire strategy implementation.
In this area, I mean, more and more tech workers are relocating to this area, right? Do you have any suggestion or any advice for people who are relocating to this area as far as tax strategies are concerned?
The people who are relocating here, number one, they have to see their purpose is long-term or short-term stay here. For someone who is just staying here for a short time, I would not recommend doing it because the property prices are so high, plus the property taxes are not deductible. It could be a huge endeavor to get in and then get out. But yeah, for people who are long-term, they should buy it at sooner the better, because the property prices continue to go up here. On the tax side, they can always compare what their mortgage is going to be and what the rent is going to be. And accordingly, they can make a decision whether they want to do it. They should calculate the accurate amount of tax benefits also available for the homeowners, and then reduce that from the rent, from the mortgage amount, and then realize what's their true cost of ownership is.
A typical problem homeowners have when wanting to buy a new home is whether to sell first or buy first. Either way is risky. When ready to look for a new home, TradeMyHome.com, powered by Your Home Sold Guaranteed Realty, offers an upfront guaranteed cash offer on your current home. Are you moving in the next 3 to 6 months? Text PAIR to 408-740-7400 for a free and no-obligation professional equity appraisal report. For more information, visit trademyhome.com or call 408-740-7400. Remember, at trademyhome.com, your home is sold guaranteed or we'll buy it.
And why is estate planning so important for homeowners today?
I think estate planning for anyone is very, very important. If you have the family that you want to protect, right? Number one reason of doing the estate planning is to avoid probate, so that after your family doesn't have to go to the court to just get the assets that you have accumulated. So the probate costs are very high. It's almost 8%. So I would say that anyone and everyone should at least have a basic living trust to avoid the probate. And after that, the estate exemption is huge right now. It's almost $22 million for a married couple. So then it's fine. As long as you have a living trust, you might not need an extensive estate planning.
Sure.
Beyond that, once you have an estate which is larger than the exclusion amount or lifetime exemption amount, then you should look into the estate planning and do it very, very carefully, because after that, 40 to 50% amount of your wealth goes towards the taxes. And if you were to see, the estate tax is an optional tax that you can easily avoid if you were to plan carefully.
Please share this episode with a friend, subscribe, and leave us a review. Thank you to our sponsor, TradeMyHome.com, for their client commitment and for making this podcast possible. If you are considering buying or selling a new home, visit TradeMyHome.com. Until next time, remember to stay ahead in the real estate game.